The stock of one of the United States' largest companies, United Health, has been cut in half since it reached its highs last November. We're going to talk a little bit about that and whether or not it's a buying opportunity at the stage today on Open Interest. Hello, everybody, and welcome. Welcome to Open Mic. I'm Mike Coe. The stock we're talking about today is United Health. This is a name we've mentioned a few times prior on the channel, but it had a lot of activity yesterday, traded about 7 times its average daily options volume. It was down another 20%. That breaks the peak to trough decline, probably something in the neighborhood of, in round numbers, 50%. And in fact, I was taking a look at this, and that decline is about the market cap equivalent of Ford, FedEx, Dell, and perhaps Target combined. I mean, we're talking about $300 billion. This company is, if you're looking at it the way that the Fortune 500 index does anyway, the third largest in the United States, public or private. So the way they like to think about things is in terms of revenues. And the full year revenue estimates for United Health is about $450 billion. The company employs over 400,000. It provides health insurance to about 50 million. And then their Optum unit, which is slightly different than the regular health insurance unit, services as many as 120 million individual people over the course of a year. So I'm just going to read some of this off so I make sure that I get it right. Two things to talk about, really. The first is that when the company announced earnings in April, they missed earnings estimates and they guided down, which is why yesterday's news was kind of surprising to people, because they withdrew guidance only a month after they guided down. But let's just go over some of the highlights. So the company revised their adjusted EPS per share outlook for the year to something in the neighborhood of 26 to 26 and a half. This is when they reported in April. And they specifically said that the revised outlook was being driven by factors impacting performance in the Medicare businesses. So I happened to review that conference call again. So they gave a conference call yesterday, which if you go to their investor relations website, you can get, and also, of course, the earnings call that they had in April. Their payout ratio, I think they said, was 87.5%. So what we're talking about is they receive premiums in, they pay some of those out, and the difference was about 87.5%. So 87.5% of what they were collecting is what ended up getting paid out in expenses. Then CEO, who has since resigned and been replaced by the company's former CEO, they were highlighting a couple different things that were driving this activity. So this is primarily, I guess, outpatient visits, but it seems like there's more people going to the doctor. There's more sort of outpatient activity going on. And in at least one of the samples, this is not just because they've been growing the number of people that they have on their platform, which I believe in the Optum side is going to be 800,000 additional in full year 2025. 98% of the members were prior members. So this is not about suddenly a different sample, a different bunch of individuals, or somehow they're taking in new and perhaps sicker members essentially to their platform. It actually is sort of across the platform that they're seeing that there's just a lot more activity. Now, some of this they think could still potentially be related a little bit to delayed services that people may have had from the pandemic. That strikes me as a bit unlikely. I would have expected that if that was the case, they almost certainly would have seen indications well before now, well before the first quarter of 2025. And apparently that is continuing at this point, which is the reason that they withdrew their guidance, and they're saying that they expect that is going to persist at least through the end of this year. So at this point, I think this is kind of interesting because as I see everybody we've had a lot of revisions, a lot of price target declines. There have been 21 price target changes, all of them lower, unsurprisingly, of course, on the back of this news. But I just wanted us to take a look at a couple things really quickly and give some thought to whether or not we think this is a situation that's going to persist long term. So I was asking myself a couple of questions, which I often like to when I see situations where companies are falling so steeply so quickly. So first things first, is there fraud in a business? That could be a reason why. So that's an existential threat. When we're talking about fraud, we're talking about Bernie Evers and WorldCom. We're talking about Lay, Skilling, and the gang over at Enron, that type of a situation. So you find out that they're cooking the books. That is existential, that is disastrous, that's a no-touch scenario. A more muted version of that can happen when you have a company that has been massaging earnings for a very long time and they run out of carpets, essentially, to sweep things under, or closets to stuff skeletons into. I think analogous to that would be something like General Electric when Jack Welch and later Jeff Immelt ran the business. So they had a very complex conglomerate, and they had the GE Capital unit. And eventually, GE Capital accounted for about half of the company's profits, and they were able to use that to essentially smooth their earnings for a number of years. And they consistently beat by a penny. But if you're honest, of course, there is a limit to how much massaging of the numbers you can do. So is it a situation like that? And I don't think that's the case here either. Okay, so what other kinds of questions might we ask ourselves about this? Is it a secular shift? Are we dealing with a coach builder for automobiles when all of a sudden they're going to go to all production factory built cars, for example? Or are you selling buggy whips as cars come on the scene? Are you Blockbuster Video right when Netflix arrives on the scene? Not the case here either. So I'm not as concerned about that either. Is there a regulatory or a liability problem that could be impacting the business? In this case, potentially, yes. The regulatory issue is there's something called V28, which if you want to do more homework on it, there are issues with respect to, for the Medicare plans in particular. So these organizations, they put bids out to the government for Medicare and in some cases Medicaid programs, and those things can be subject to change, right? And in fact, what they're talking about with the reimbursement rates is largely their older members. So these are people that are typically going to be covered by Medicare. So it's Medicare plan type things. But you can get constrained by a couple different things. How often are these people going? How much do the services cost when they do go? And how much are they allowed to get reimbursed? And it is in this area that the business appears to be getting pinched a bit. They still continue to take on new members at about the same rate as they did prior. As I pointed out, they're covering about 50 million people already. Optum's got about 120 million. So, and 90% of this is US. So, at some point you do start running out of room in terms of growth. Nevertheless, what I was thinking about was, okay, let's just assume for the sake of argument that their top line slows and their margins decline to a level that's probably towards the lower end of the long-term range. So I'm going to start toggling some of this stuff off so we can kind of get a look at what I'm talking about. And I'm just going to get rid of price to sales. Okay. So I probably want to just leave this little blip out over here of the margin calculation. So why don't we just take a look at a 10-year history. So we had this big drop off in here, but their numbers are probably running around the high fives, low sixes in general. let's just assume, for the sake of argument, that their margins actually fall into this neighborhood here, okay? About 4% net income margins. And they're going to do $480 billion in revenues next year is essentially the estimate. So that works out to, $19.2 billion, okay? And right now, the equity market capitalization is $280 billion. So that gets us to about 15 times a 4% margin number, which is basically scraping the bottom of the barrel in terms of what they have done historically. So as I look at this, and what first got me looking at it was, how does it look on a price to sales basis, right? So you try to look at the biggest things first. If it's not a secular shift, are their revenues going to keep growing? And can they get back to some kind of margins that seem reasonable? So I started looking at it on a price to sales basis to see how expensive the company was, and then we'll start normalizing for things like margins. And this is a really long-term history now. And now you can see here, this says 1.178 or something like that to price to sales. It's not anything like that, because this is for the quarter. It's actually much lower because, as I said, the company's worth about $300 billion now on an equity basis, and it's going to do $450 billion in revenues this year, full year, okay? So if we figure that this is about average where that white line is, this is about where we are now. And you can see that the only times in the last 35 plus years that it has been below this level was in the great financial crisis era back here, and in this region right over here. So this right here, if you can't see, this is actually 2000, right? So this is late 99, early 2000. This is pretty rarefied air for this business. So, my thinking is, and, I usually have something called the 3-day rule. I'm not the only one who says this. Really, the logic here is that when new news comes out and that news is negative, institutional holders need time to unwind their positions. And we have seen some pretty big unwinds. I think it was Fidelity. They sold something like 5.5 million shares. I'm going to just double check this. That's a big number, right? That's $1.5 billion worth of stock. So let's just take a look at the bigger sellers here. Yeah, so Fidelity, and that's closer to 6 now. Okay, so I was looking at this yesterday. I must have missed one of the funds that was in that. Now, I don't know what the average sale price was. They still have quite a lot left, as you can see, about 24 million shares. But they are sellers, and they may continue to. T Rowe. This is what we call real money accounts. These are the actively managed mutual funds. So FMR is Fidelity Management Research. That's the mutual fund side of Fidelity, rather than the self-directed brokerage portion that we tend to think about. So these are going to be the active managers. We can see that there's some decent size selling. If they are still at work, they've got a lot more to go. I'm not saying they're going to blow out of everything, but maybe they simply reduce. But that can introduce significant selling pressure. I mean, if you figured that just these big sellers right here were going to let go of another 50 million shares, I mean, 50 million shares at $300 a share, we're talking about 15 billion bucks. It's a lot of stock for the market to absorb. But I do think that this is a spot where you probably want to consider thinking about kicking the tires. This is now a chart of the implied volatility. And I think this is also something that one might consider taking advantage of. I'm going to actually shorten this up just a little bit. So you're going to see that 3-month implied vol is very high. I'm actually going to look at something a little bit shorter in here. And the reason for this is, and actually that's probably, let me see when the next earnings is. So they reported in April. So that means they're going to be reporting in July. When in July are they anticipated to report? And let's hope they don't have another pre-announcement. The 16th, so that means July options are probably going to capture it. So in terms of options that I would suggest at this point to trade it, if you are so inclined, I would probably take a look at selling premium that expires before that next earnings event. I'm kind of guessing that we're not going to get, additional negative news before that, but my other thinking is, with the old CEO coming back, that there is a decent chance that what's going on here is it's not kitchen sinking it necessarily, but you guys are familiar with the concept. Basically, what's going on is, you want to give the incoming, we'll call him returning CEO, a little bit of room. And so I was looking at this and thinking, okay, well, let's just say you're looking at something like a 16 delta strangle in this thing. That's going to be something like this, something like the 260. I got to put this as to a call. That's going to be something like this one here. Something like a 260, 375. And, that expires. Oops, that's the 27th. Sorry. I really kind of wanted this one here. Just June regular way. We're just going to try to keep this relatively simple. This is a 260s. 15 delta is fine. 380 call, 13 delta. Let's bring it down to the 370. I don't think it's going to probably exceed that. That would be well over a 20% increase from here. So that's 9 over 300. So you're looking at a 3% yield in 37 trading days, right? So that's almost 30% annualized. Downside is you get long the stock at 260. Now, for those, I wrote an article. I put it on the Options Edge. For those of you who subscribe to the Options Edge, you may have read it there already. Another possibility that I think makes sense here, if you're really looking to make more of a long directional bet. Bear in mind, like I said, there's probably still going to be a little bit of softness as institutions are, figuring out what they're going to do here. But this is another situation where you want to be short more options premium than you're actually long. So, a call spread risk reversal, which, by the way, is just the short strangle with the addition of a call that's somewhere close to at the money. That's going to look something like this, and I think that's a fine strategy too if you're just looking to try to play it for a potential bounce. But it's probably going to take a little bit of time for us to get that bounce. Can never really perfectly time the bottom or pick the bottom. Not trying to do that. I'm just saying that, man, there's a lot of bad news priced into this thing already, and I rather like that as an opportunity. Okay, so I'm just going to hop over here and see if I can find some comments and take your questions. And yeah, let me see here. It's going to take 1 second for me to kill a few things because I seem to have... Oh, here we are. Okay. By the way, many thanks to those of you who tuned in for a more unusual episode on Monday that I had Scott Goldfarb on. It turned out that actually the head of YieldMax and the head trader were both on that, which I appreciated. So let's see here. Okay, so Steve, do you think it's advisable to stay away until the company gives guidance? Because the moment they do, the stock will reset instantly. Alternatively, could sell June puts like the 240, 280. Well, first of all, with respect to selling the 280s, I think the 280s I have the 260s here. A cash covered put is fine. If you listened to their call, I think they were being cautious. That was my take. That was kind of the tenor that I was taking away from the call yesterday. And their expectation is, and what they said is that their intention is to basically course correct back to the margins and growth that they had previously guided to. what I'm saying is maybe they will, maybe they won't, but they don't need to because the company's been cut in half, right? So it was priced for what they were previously expecting. Now I'm just saying they don't have to steer back to what they had previously expected. If they do something that is only, you know, two-thirds is good, three-quarters is good, you know, that could be a 50% pop from here. So that doesn't get you back to where it was before. It has to rise 100% to get back to where it was only last November. But I'm saying, okay, I'm willing to accept that the company's not going to do as well as it once said it would. And still that's okay because it is trading at such a significant discount. But it's a fair point, right? There's two thoughts on this. One is you can find a stock like this that has decades of excellent performance growth. Like I said, over 400,000 employees. I mean, they've been managing this business pretty successfully for quite some time. And you can say to yourself, okay, now that I can buy it for half of what it cost 6 months ago, perhaps that's a decent deal. There are others who are going to say, you know what? I'm going to wait until they say they've fixed things. And I recognize that when they do say that, the company's going to have bounced, and I'll buy it at a higher price with greater visibility. So I think both of these are, both reasonable approaches. I'm inclined at this point to dip my toe in at these levels. That's what I'm doing. And I think, you can decide for yourself whether you want to get better visibility or not. I'm just sort of presenting what we've got, and then everybody can sort of make their own minds up. But I just wanted to give everybody a way to sort of think about it. We have well above average options premium. We're talking about being a premium seller into this. A lot of bad news has taken place. We had the Brian Thompson shooting. I mean, it's 3 bad things have happened in rapid succession. So we had the Brian Thompson shooting, we had an earnings miss, we had a guide lower and a withdrawal of that guidance and a change in the C-suite, material change in the C-suite. So, you put all these things together. Could it get worse? Could more bad news come out? Of course. And they actually did say, and I think this is priced into it. They did say that the diminished margins are going to persist through the end of the year. So it's about 50 basis points, I think, that they were suggesting on the April earnings call, and they were talking about the payout ratio. They were saying that's about 50 basis points worse. So that's 50 basis points of whatever the revenue number is. That's not an insignificant number, right? So if you think about it, that's like $2.2 billion when you have the kind of revenues that they do. So it's real, but. Okay, so good morning, Mike. I got an email noting you'll be on the panel at the Vegas Options Action Masterclass in July. I'll be going back to the USA just a week later. Too bad I'll miss the meeting. Yeah, is that what they're calling it? Options Action Masterclass. I didn't know that's what they were calling it. I'll have to go take a look at the agenda. But so there's a conference that takes place regularly. It's called the Money Show. I don't usually do the Money Show things, but I have done them once or twice in the past. I know the person who runs the Money Show, and she reached out to me. And this is supposed to be for higher net investors and maybe some RIAs, I believe. And so that's an audience I'm very happy to speak to. So yes, that's going to be taking place in July in Las Vegas. So for anybody who happens to be there and wants to come see that, me or anybody else in person, will be available. If you watch the live stream, mention that, and be very happy to talk to you in person if you show up for that. Okay, and so then you followed up with what opinion might you have on Walmart and Deere earnings? Deere has handled the market volatility pretty well in 2025, trading near its high, bullish on both. Yeah, it's funny. I've long liked Deere. One of the reasons I've liked Deere is because they are a little bit less cyclically dependent on mining and construction. However, as you know, they are dependent, of course, on agricultural commodity prices. So as agricultural commodity prices drop, then you get this sort of super cycle in spending on farm equipment that can, go down. And we're kind of in that phase right now. We had a whole period of very high ag prices, and that sort of fueled this massive growth in spending, tractors, combines, all that kind of stuff. And you can see that here. So, we got up to just over 61 billion in total revenues in 2023, full year. And this I think is a really good, I'm going to blow this up a little bit more in case you can't see this, because I think this is one of the really big reminders that when you're dealing with a cyclical business, how profound the shift can be. So the full year estimated revenues for Deere, 38, I'm going to round it, 38 billion over 61. So you're looking at a 38-ish, 37, 38% top line revenue decline. But this is actually, interestingly enough, this is one of the longest publicly traded companies in the United States. Deere was founded in the 1800s, for those who don't know. They are also contending with one other issue, which those of you who follow the company probably know, and that is the right to repair. I don't know if anybody is familiar with this concept, but farmers buy equipment. Some of them keep it for a long time. When things break, they fix it themselves. Probably unfamiliar to most of you. I didn't grow up on a farm per se, but my parents had kind of a gentleman's small farm, I guess, horses and things like that, and some farm equipment. And it's not uncommon when things break that you want to try to repair it yourself, because it's not convenient necessarily to have somebody come with a truck and haul the thing away and fix it if it's something you can weld or hit with a torch or bang with a hammer and make it work. That's usually the first course of action. Well, farming equipment has become much more complicated and a lot more electronic, and the company was trying to make it so that basically only the authorized dealers were going to be able to do certain types of repairs. Farmers have been fighting back on that. I think they might be making some progress. But yeah, I think, typically you have these cycles. I expect that cycle to reverse relatively soon. And, when it does, this is the thing to keep your eye on. So you can see that their peak profits recently, 35 bucks a share. It looks very expensive right now because we're approaching sort of the bottom end of the cycle. And that's an important thing to remember about cyclical stocks. Cyclical stocks will always seem cheapest at the highs and most expensive at the lows. So think about that for a second. Cheapest at the highs and most expensive at the lows. Why? Well, because at the lows, at the cyclical downturn, their earnings are going to be, and you can see this, their earnings were almost cut in half from their 2023. That's the fiscal year ended October of 23. If they were trading at that same, if they were making the same net income now that they did then, you'd be looking at a stock that was trading at 14 times, right? So I do like Deere. I don't think it's terribly cheap here, but I do think that probably, we're going to start to see a reversal in that trend. Now let's move on to Walmart. This is an interesting one too for me. Let's talk about the bull case first. Things that we are working for Walmart. They buy back stock, big hodler concentrated positions because the Walton family owns most of it. Their digital stuff has been working out very nicely. They get better margins on the things that they sell than some of their competition. They're more than 50% grocery at this point. I think they're 18% digital. And the nice thing about that is that, and unlike the grocery that's, say, sold in Target, for example, we're not talking about processed goods that sit on a shelf and last for months. They sell fresh produce, meat, all that kind of stuff. And the reason that's important is because people who shop for groceries do so every few days, right? So they have a lot of that share. They're getting more of it. It does have carry-on benefits for the merchandise portion of the business, which I think is also a plus. There were concerns that Walmart was going to be affected on the general merchandise side by import tariffs, and it now seems like we have a little bit of resolution on that front, so that is also good. So all of those things are the positives. What are the negatives? Well, the negatives are, you can see from this, and let me blow it up, multiples not cheap. Let me blow this up like this. So if we're just looking out to next year's earnings, I'll even round this up. Let's just say that they beat. We'll call it $3 a share. So that's, 32 times full year, calendar year 2026 earnings. This, I know it says 2027 at the top, but that's because their fiscal year ends at the end of January. Compare that with something like Kroger, which is trading 15 times. I'm not saying that, Kroger doesn't have top line growth. Walmart does, and they have somewhat better margins, but just something to think about. And I've compared them also to Amazon, right? Because Amazon's trading 24, 25 times. So it's 5, we'll call it maybe even 26. We'll say that it's 5 turns cheaper. And these are businesses that compete in a lot of areas. So I've said it before. I mean, I'm a little bit perplexed, but I kind of like Amazon relative to Walmart. But as an operator, and I think this is interesting, the former CEO of Macy's was on CNBC. I'm going to say it was probably about 2 weeks ago. You might be able to look this up and find it yourself. And he was asked, what he thought of Walmart, what he thought of the current management of Macy's. And, he basically said, if he could buy any retailer right now, it would be Walmart. And why do I think that's important? Well, we just had Warren Buffett stepping down from Berkshire, but one of the things he has talked about, I don't know if he talked about it at this most recent meeting, but he has talked about it in the past, is that when he first started out in the business, he would go and interview management at a number of different companies. I think the example he used was coal companies. And he would talk to each and every one of them, and then he would say, if you had to buy one of your competitor's stock, not your own, right now and hold it for 10 years, whose would it be? If you had to short one of your competitor's stock, not your own, and you had to do it right now and hold that position for 10 years, who would it be? And, he said oftentimes he would learn more about an industry from what they would say about what they would do and why than maybe even any one CEO would know. The reason I highlight that little anecdote is because if other retailing CEOs think so highly of the way Walmart's running their business, then probably we should too. These are people who understand the industry, they understand the business, and if they say you kind of got the best management going on there, you got 51% of the stock or something like that in the hands of the Waltons, they're not selling any, and if anything, they've typically bought it back. You got good positive free cash flow, and they are moving increasingly into the digital space. That's great. I will say this, if I didn't say this on a prior live stream, I want to make one quick point about that, because I think they had, it's like an 18% of their total revenues was on the digital side, and it was growing faster than Amazon's top line. But I want to be very clear about something, and that is that I don't think, this is not them stealing market share from Amazon. I think what you're getting is a migration of other bricks and mortar to Walmart's digital platform, and maybe some of their own, because their overall general merchandising sales are not growing. So if you include bricks and mortar and digital, it's not like it's taking off. That actually is growing more slowly than Amazon's general merchandise sales are, but their digital side is growing faster than Amazon's, if that makes sense. Hope it does. Okay. Okay, so let's see here. PC says, PC, how to manage a call spread, risk reversal, close the wing really cheap, and close the strategy. I think you tried to ask this, maybe it was you. Somebody asked this question on Monday, and I'm glad you brought it up, especially since I just referenced a call spread risk reversal in here. Where did I put that? Let me bring that back. So yes, short version, or the long version, depending on how this goes. So let's use, what the heck? Let's use Walmart as an example. And then we'll just run through a hypothetical. So call spread risk reversal, you're short more options than you're long, so you're looking to be in that neighborhood of, we'll call it 6-7-ish weeks. A nice blend of, you get some time until expiration, but you're hoping for some decay because, like I said, you're short more options. So we'll just build this one in here. We're at 90, so we'll buy the 97s. Just keep it easy, buy the 97 calls, and we'll sell, what are we here? Not going to sell the 97s, that wouldn't make much sense, because that's just a synthetic. Let's go to the 90s. Okay. So here, this is kind of even money, right? So get long the stock at 90, which is down 7% from where the stock is currently trading, long at the money, and you have 13 bucks worth of upside. That's pretty attractive trade, right? Just like that. Okay, so what do? If the stock rallies, a couple things, and two things are going to happen. As time passes, those wing options are going to start decaying away pretty rapidly. So if it just stays here and those options start to get cheap, you would probably want to cover them. Now think about this. Remember that in a call spread risk reversal, you're short a strangle. So kind of think about like the tasty trade approach to all of this. There's a decent chance that after, in a 6 to 7 month short strangle, you're probably going to want to cover and roll on those options after about 3 weeks or so, when there's 3 weeks left. Why is that? It's not that the value of those options as a percentage of their own value is not decaying rapidly. It still will be. But as a percentage of the stock price, you're really not capturing a lot of yield. So the return on your risk capital is not so great. What do I mean by that? If I had $1,000 stock, okay, and I sold an option for 15 bucks, 1.5% of the price, and it dropped to, for the sake of argument, $5 after 3 weeks. Well, most of the money has been made, and the $5 can decay very rapidly. It could go from 5 to 2.5 really quickly, but 2.5 over 1,000 is not a whole lot, right? So you're risking a lot to make a little relative to the stock price, and that's one of the reasons why you would look to cover that. Okay, so that's the first circumstance. Time passes, the strangle on your call spread risk reversal has declined. You can look to roll the whole package or at least cover the short side, because now you're picking up pennies in front of a steamroller. Okay, that's the first thing that can happen. What else could happen? Stock can rally. So now it's gone through your long strike, and your higher strike call probably hasn't come down very much in value because your time has passed. That's a plus, but the stock has gotten closer to it. That's a negative. So your long call has appreciated probably. Your short call has maybe done little. It may be up slightly or about the same. But your short put is now going to be worth considerably less because two things have worked in your favor. Time has passed and the stock has migrated away from the strike. You want to almost certainly cover that. What is the metric that I typically will use? This varies because different companies have different levels of volatility, different levels of leverage. There may be events coming up, but I'm just trying to give you a guideline that I have said before, that being short options is taking an equity-like risk. If you're taking an equity-like risk, you want an equity-like premium. For me, that's about 1% per month-ish. So when I start seeing it dwindle well below that, that's when I'm going to start looking to roll. If it comes in, at less than half of that number, so now you're looking at 6% annualized, it's almost certainly going to be something that you want to cover. And you can do that both ways. So if the stock comes down a whole lot and starts running towards your short put, that short call on the upside might also be worth covering, again, because you're just not getting much really to maintain a short in it. Okay, so I hope that helps. All right, Alex V. Home Depot and Toll report next week. Expect weaker numbers related to the real estate market. We've been in a multi-year housing recession, basically, on the home builder side. That's going to affect Toll. That will also affect Home Depot. Home Depot has a much higher mix of contractors, of professional sales to professionals, than Lowe's does. So I think the number is single-digit percentages at Lowe's. And the last time that I confirmed this personally with Home Depot management, it was over 40 at Home Depot. But I haven't spoken to them in a while. That was, I'm not even 100% sure. I may have covered it on this live stream, maybe not. It could, time can get very fuzzy, but I did actually call the company and speak to somebody personally because I was reciting that number, that it was more than a third of their sales was coming from sales to professionals. at Home Depot, and I think the number was north of 40, but just bear in mind that that's stale because I didn't speak to anybody over there. It's probably like 18 months or so, maybe more since then that I talked to them about that. Hi, Mike. I just bought one of Bill Gross's books, Thoughts on Corporate Bonds, from Spicy Barbecue Tasty. Boy, could I use some brisket, and we don't seem to have really good brisket around here, in my opinion. Brisket and pastrami, two of my favorite things in the whole wide world, and they're related. Okay, Bill Gross's book. So first of all, I really respect one of his big competitors, Jeff Gundlach of DoubleLine. I think very highly of him. He has a very good track record. He has suggested that, Trip B's, not too much duration. So Trip B is still investment grade. Going out 5-6 years is probably the sweet spot. I think he probably still is on board with that. Here's something to think about. You're going to get a little bit, if we get into a recessionary environment, and I'm going to show you something in bonds in a second where I don't know that we're necessarily going to get there, but I'm just saying if we do, or if we get better than expected inflation numbers, what's going to happen? That's going to bring down the short end of the curve. If the short end of the curve comes down and you have, say, 2 to 3 year paper, the issue you're going to have is you're going to get refi risk, right? So depending on what your time horizon is, I kind of think the belly of the curve might be a better spot to be. So that's my first observation on the fixed income side. I'm not a fixed income guy. Something else that has occurred to me on the fixed income side, and that is spreads. So high yield spreads blew out a bit, and then they came right back in. So if you are an equity person and you're trying to say, okay, well, how is the equity options market's view on risk? A good place to look is high yield, because typically high yield spreads will blow out considerably if there's a recessionary risk. And if you look at this chart right here, the thing you're going to notice immediately, let me just look at this here, is that we're basically right back to where we started, right? So that whole swoon that took place and really punched everybody in the nose on Liberation Day, that has all come back completely. That's the first thing. The second thing I think that is kind of interesting is that the risk assessment on the options side has also almost completely evaporated. Take a look here at, I'm going to look at 3-month options in HYG. So what is HYG has bounced all the way back. And let's take a look at where, so this is 3-month implied volatility, and this is a history of it over 2 years. And here we are at just under 6%. So I don't think it would be one of the things I was talking to Mark Guthner about yesterday was, because he's more of a fixed income guy than I was. After all, he ran a fixed income portfolio at Pru, a Taft-Hartley pension. What do you, normally the way we look at hedging, for downside situations is we will look to, what's first to go. Equity goes first, right? So if you're just looking at the waterfall of a company, equity is the last guy to get paid, so it's the first thing to go. And then you start, going further and further up the cap structure to see what looks like an interesting hedge. I actually wondered whether this might be an interesting place to play, because as you can see, we're right in and around that mean, even slightly under it. You can see that 3-month implied volatility, 5.85%. That's below the 2-year average. And you can see how high it got recently, right? So 3 months actually, June, July, it might be, I kind of prefer actually probably getting out to September. So 3 months might not be quite long enough. But yeah, if I was looking at, I don't think, just quickly going back to the first part of the fixed income question, I wouldn't be a buyer in the high yield space right now, because I just don't feel like the spreads, I think there's plenty of uncertainty. Spreads came right back in. We saw how quickly they can expand. within the last, 4 to 6 weeks. I think, like I said, triple B, 5, 6 years, that like that. I think that's probably the place to be. Not taking on too much duration risk, not taking on a whole lot of refi risk, and you're not taking on a whole lot of credit risk. There you go. But I'm not the expert in this, right? So, okay. Joe came in. Hi, Mike. As of recent, much of Liberation Day corrections have recovered. Yes. Are we being too complacent, realizing supply could still be impeded, in the next quarters? Inflation may rise. Any prep we can do? Excellent question. I think you're asking yourself the same question almost everybody is. One of the things I think that is kind of interesting here is that a lot of the forecast, look at the most recent inflation data we got. The most recent inflation data we got came in lighter on every metric by about 0.1%. So, people were expecting hotter numbers. I think the whisper numbers were definitely on the high side, and they came in light. So maybe I'm cautiously optimistic on the inflation front, believe it or not. And I'm not typically that way, but I kind of am at this point. So that's the first thing I would say with respect to that. The other interesting thing is that usually the equity markets and the high yield markets do pick up on recession concerns, and usually it's the credit market that catches it first. So if you're looking for cracks in the ice, look to credit. So you could look at something like HYG, or you could look at credit spreads, CDS, that sort of thing. And this is not my observation. It was something I heard Tom Lee of Fundstrat say just recently. I mean, he may have said it yesterday or the day before. But one of the things he said is that when you recover more than 50% off the bottom, that means that the lows were probably in. He was saying that only once in 22 instances did that not signal the case. 21 out of 22 times when you had a rebound like this, that means that the bottom had been put in. Is it going to be true this time? Well, 1 out of 22 instances it was not. So this could be 1 out of 23. It could make it 2 out of 23. But he was generally optimistic, and I will say this: it doesn't pay to be a pessimist all the time. And a lot of times when I'm on Fast Money and we get to talk about something very briefly, and that's very much a trading show, and we don't get to talk about things for a longer period of time. We often will talk about the things to watch out for, the things to be concerned about. But, the thing to be concerned about over the long run is not being invested. So, if you're not as concerned about actually bottom ticket, look, we're not all the way back to the highs. So, one way to look at it is that some of these stocks, you're still picking them up cheaper than they were earlier this year. So, not a complete disaster. Thoughts on Uber? Carter shared a bullish chart, but Tim would rather LYFT at these levels. Oh yeah, somebody who was watching was asking about LYFT going into earnings, and I don't know if you wanted to share or not share. If you happen to be watching today, was long in the money calls, out the money, and out of the money calls. If you held on to it, which I think I pointed out at the time, the options were very reasonably priced. That I think was the words that I may have used. I think they were implying a move of about 12.8%. Again, I'm going by memory, and then it popped 22%. So good on you. We all should have followed what you were doing, and hopefully that all worked out for you. I do like Uber, like the business, and I've heard Tim say that too with respect to LYFT. Let's just take a quick comparison of their multiples. So LYFT is trading 16 times full year, and Uber is trading. Uber, I think, I like their business a little better, I have to say, because they've got the Uber Eats. I think Uber has become a verb. What are you going to do? My son's leaving the house, and where are you going? When are you going to be back? How are you getting back? How are you going to get back? Uber. I'm going to Uber. So yeah, I think that it's very much a best of breed and pay a premium. It's trading at twice the multiple almost. Um, but I think this is actually kind of an attractive business. I mean, look at it this way, as far as LYFT is concerned, and I think this is probably, I don't know what Tim's thesis was. I think I've heard him mention that he likes it better. But this thing is trading, what, 12 times less than whatever? Full year 26 numbers, growing at a nice rate. What do we have as a free cash flow yield? This is nice, right? So if you're looking at 2026, it's 10% free cash flow yield. $7 billion business. X cash, it's better than that. That's probably what he likes so much about it. Full year 680 over free cash flow yields 11% for this year. Yeah, I guess I like them both. I mean, but for different reasons. I prefer to be in the best of breed, but LYFT, I mean, they're growing nicely, excellent free cash flow yield. It's cheap. How about the options? Let's see what those look like. Probably milk some nice premium out of that. They're going to be reporting next on the 7th is what they're estimated. So, yeah, I mean, maybe another. Might also be a call spread risk reversal candidate. I certainly wouldn't just sell naked upside by selling strangles in this thing. I'm not selling strangles in anything that's got an 11 is growing free cash flow in double digits and has an 11% free cash flow yield. Thank you very much. So this would be more of a call spread risky trade, but I like them both, different reasons. Okay, so Steve Garcia, just to follow up with United Health, do you think companies of this size and importance tend to give future guidance before next earning? So, first of all, the company has historically provided guidance, and now they've lowered it twice in, basically a month. It's pretty unusual what's going on here. I think what your real question is, they're going to be announcing earnings in July. Do I think they're going to pre-announce? That's really the fear, right? So if you're going to get short premium expiring in June, do I think that the company is going to pre-announce before July? I'm guessing no. And the reason I'm guessing no is because I think if the trend was tailing off so severely, they probably would have tried to bake that into what they were announcing yesterday. And I think the street baked a lot of that in. The stock was down 22% yesterday. It was 22%. It was in that neighborhood. So don't quote me, but it was. I think it was down 22% when I was looking at it anyway. I don't know if that was the actual close to close decline. I don't anticipate a pre-announcement. That would be a really ugly look. I think it's far more likely. Look, the prior CEO they're going to have they reduce their guidance. They came out, said actually the picture is a little bit worse even than we said it was 4 weeks ago. The CEO has agreed to step down. The board has accepted that decision, and we're bringing back the old guy. If the old guy then comes in 4 weeks later and says, I know I'm going to be announcing earnings in 3-4 weeks, but it actually is even worse than it was when I came in, I kind of doubt that. But yeah. Eileen says, it was also a horrendous flu season. I wonder if that factors into United Health guidance. So they specifically alluded to the fact that they were dealing with an increase in outpatient visits. But what is interesting is that on the prior earnings call, the CEO was complaining about procedural costs. And the procedural costs that they referenced were stents, hip replacements, things like this. So while I definitely think it's possible that something like a flu season could have impacted it, it sounded a lot as if the kind of things that the procedures that they were getting hit with were those types of things. In fact, they specifically said that in Germany and the UK, and they mentioned one other country, that those procedures specifically, like a hip replacement, like a stent, is about 25% of the cost in Germany and the UK as it is here, and that something has to be done about it. I kind of suspect that when they made those kinds of comments, they were kind of thinking about those types of procedure costs. And so I think the mix, and I haven't seen all of that data because it hasn't all been released, but I have a feeling that some of that's going to be outpatient illness related, but some of it is outpatient. Not that a hip replacement, that's very serious surgery, but I think a stent might be an in and out. Monday morning quarterback wanted to follow up on MSTY. Hey, by the way, it's interesting. Since Monday's thing, I spoke to the CEO, the co-founder of YieldMax and the head trader on a separate call. I actually spoke to them earlier today. So you wanted to follow up. Best to look at the high yield fixed income since they've hedged off most of the upside. Yeah. And by the way, MSTY, very negative skew. So yeah, there's a functional reason for this. I think I touched on this on Monday, but I just want to do this again so that we're clear about why there's so much negative skew. So if you can imagine, I'm just going to get rid of this one from a week ago. So we're just going to look at this. I want you to imagine that we're just going to look at SPY. Okay, I'm actually going to put SPY in here, so we can compare them side by side. They're going to have very different volatilities, but bear with me for a moment, and hopefully I can make some sense of what I'm talking about. Okay? All right, so here we go. Imagine you own SPY, and this is the vol surface for SPY. What is the vol surface for SPY if you sold a call option on the upside, right? So what does this upside volatility represent? A couple of things, right? So one of the things it represents is that as the higher implied volatility goes, ceteris paribus, something I said on Monday, all else equal, the delta of those options to the upside is getting higher. What you're saying is that the likelihood that it goes sharply higher is greater, and that the volatility once it gets there is also possibly greater. And that's clearly not what you see in MSTY. What is MSTY? MSTY is Mr. MicroStrategy, but you've sold upside calls. Well, if you sell an upside call and the underlying asset shoots through the short call strike, the overall position, which is what MSTY would be, what's the volatility of that at that new price level? Well, it's going to be zero because the stock is 100 delta. So the stock goes up and down, but your deep in the money call is also 100 delta. So I'm long 100 delta with my stock and I'm short 100 delta with my call. No matter what the stock does, as long as it's well north of that short strike, there isn't really any volatility in the underlying asset. And there is no chance that I'm going to see profits because I've already sold them off with my short call. That's the reason why you see this big negative skew. So don't interpret it. I would not interpret the negative skew here as a highly negative perception of MSTY by the options market. It's just dealing with the underlying reality that a position with no delta doesn't move, and it has no delta at those higher strikes. Now, that's a generalization. The reality is that depending on what implied volatility in MSTR is, they're active managers. They can actually tweak their position somewhat. So instead of just selling upside calls, they can instead sell upside call spreads, which means that the delta actually follows a path. It goes from higher, maybe it's 70 delta now. As you run through the short strike, that delta drops, it drops, it drops. Depending on how wide the call spread is, maybe you're down to 20 delta at some point in there. But then as you blow through the long strike of the short call spread, at least for that portion where you're not, just completely covered calls, you're getting some of that delta back. So that delta follows a curve, and that's one of the reasons why I was actually wondering, and you have to monitor this, and you can do that by just looking at the construction, and you can see that they post this. You can go to their website. Go to YieldMax's website, look up the ticker, and it'll show you their positions because they update these things. I believe, I ran one of these funds. I ran an actively managed 40 Act fund, and ours was daily transparency, which meant that we published all of our positions at the end of the day, and I think they were on the website by midnight, if something like that. I don't know that it matters that much, right? What really does matter is that you can go and look and you can say, okay, well, yeah, they're short all of these calls. We can see that. But then as you look around, you might find that they're long some as well, like these 465s. They got 34,000 of those. They got 13,000 of the 420s. They got 18,870 of the 480s. These are just massive positions, by the way. I just have to make that point. So the truth is that MSTY hasn't sold off all of their upside. So you net all of the longs and shorts off against each other. You can figure out how much are call spreads and how much are just covered calls. You could actually calculate their delta, and at various points, you're going to assume basically at expiration, like that. So, yeah, I think that's something worth thinking about. But MSTY, by the way, just so everybody's clear, it has. I did the math, and I think I showed everybody. If any of you were watching, were not watching, then do I have? Here it is. I just happen to keep this up, so I have it handy. That is the proximal delta. Okay, this number right here, this second. So it's about 72 is the delta of MSTY to MR. That's over the history of MSTY, which goes back, I think, like 18 months or something. Don't shoot me if I'm wrong on the exact, but it's over a year. So it will track. If MicroStrategy drops, this will drop. If it rises, it will rise, like that. Okay. Corey Henderson, any data on putting on risk reversal in stages? For example, buying long calls on weakness, selling the short put on more weakness, and selling short call on rally. So I often will do that. And this might surprise you a bit, but I tend to do that more in highly volatile circumstances. Because usually, often what happens is volatility has a tendency to undershoot. Implied volatility undershoots realized, which is to say that suddenly things start swinging around and vol shoots up, but market participants are expecting it to revert. So I might buy a call, and there's one of two things will happen. The stock's weakness ends and it rebounds, in which case I'm perfectly happy to have just been long the call. Or it persists and volatility rises still further and I have an opportunity to sell the downside put. And this goes to that same conversation I was having at the beginning of this. Catching a falling knife is a tricky business, and timing it perfectly. If any of you know how to do that, let me know. I don't have a crystal ball. I can't do it. So I think it's totally fine to leg into it. And actually, something I've seen a lot of people do is they go into it in pieces. So, for example, if they're going to work their way into a spread, put spread on the downside, so I'm just going to use this as another example. Instead of doing just one up, they'll do 2 by 1. So they'll buy the puts that they want, they'll sell a lower strike put only once, and they'll sort of manage to a delta. If it continues to decline, they'll sell more puts, and if it rallies, they'll buy the cheap puts back and try to trade around it that way. So there's different ways to skin that cat, but absolutely, you can certainly leg into these things. You're taking on more risk when you do that, of course, delta risk, by definition, but yeah. Tucker D Dog, Ari, Uber Eats years ago could order delivery and just pay the tip. Now the delivery prices are different than the menu prices, and the Uber driver expects huge delivery tips. So, quick point on that. You can have a membership, and if you have a membership, then I think that adjusts the fees as well. So I don't think I have it, but I'm pretty sure that other people in my household do. Max convexity, MSTY is a monster. It is, and this is really kind of an important thing. It's about this in any funds that make distributions. it's important to take a lot of people just look at the stock prices of things, and it's a difficult thing. I'm not going to blame the data providers, but when you have a situation where the dividends being paid out are so enormous, and someone just looks at a price chart, the price chart tells a very different story than the total returns do. So here we're looking at a 1-year chart of MSTY, and if somebody looked at that, in fact, even our good friend and colleague Mark Guthner, who, by the way, does a lot of overwriting in Bitcoin and a lot of overwriting in MicroStrategy. He's killed it in MicroStrategy. But he does a lot of overwriting. He said, I don't understand it. I've been overwriting MicroStrategy, doing really well. I don't know what's wrong with that fund. And I said, nothing's wrong with it. You're not accounting for the distributions. If you account for that, it's working out great. And that's the difference between the orange line, the orange line and the white line, right? If you have a huge dividend payer and you don't count the dividends, it won't look as good. Pretty easy. It is a monster, and it is pretty interesting. Okay, so where are we? Oh, we've used up over an hour of your time. Super chat, $5 from Tucker D Dog. Can't make Las Vegas? I'd buy you a coffee there. Does $5 get you a cup of coffee in San Francisco? It does get me a cup of coffee. The kind of coffee I drink, which is just plain black coffee. My wife has fancy lattes. And just like that old bit from Real Men of Genius, the Budweiser commercial, which I absolutely love. Why do they call it a latte? Because it costs a latte. I don't buy lattes, though. So thanks for the $5. Appreciate it. It's a nice gesture. All right, so let's see. Did I miss any here? We've got the Toll Depot. We've gotten deer, horrendous flu season, and all the rest of it. Yeah, so anyway, just to button this whole thing up before I sign off here, could United Health fall a little bit further? Let's take a look. Let's just do one final thing before I sign off. Let's just take a look at what the technicals are saying, because I was looking at the, at the fundamentals. Commodity channel index is the only one of the better performing technical indicators over the daily indicators over the course of the last year that is actually positive here. We'll take a look at the weekly ones. And here too, we got a couple that are positive, but they're mostly negative. And actually, when we were looking into options play also, if you use options play, you probably saw at the top, their indicator is also negative. But I'm just looking at this thing from a fundamental standpoint and saying, you know what? I think it's getting very cheap here. Absolute bottom, probably not. But we're right in that realm, and something like a call spread risky or a short strangle. Short strangle, you're not bottom ticking. You're hoping, obviously, that it's closer to the bottom. You don't want to get short premium if it's going to have a sharp V bottom. But, the general sense of it is that the valuation here is starting to get pretty interesting from my perspective, and things are darkest before the dawn. Could be wrong about that, but that's the way I see it. So for all of you guys watching, I really appreciate it. As always, thank you very much. Like, subscribe, notification bell, tell your friends. On Friday, we're going to do it a little early, 12:30 instead of 2 o'clock, because Mark Guthner has some other obligations. So hopefully we'll see you then. Thanks for watching.